Hello and welcome to my 2025 Money, Money, Money series. Now, as we proceed through this series, each topic is an advanced topic. Today, we're talking about the four types of financial analysis. They are not all the same, they are not used interchangeably, they are different. So, the first kind of financial analysis is a should cost analysis. Now, a should cost analysis is exactly as it sounds. This is primarily a procurement function, and the customer develops its own analysis of what a product should cost. This analysis is commonly used when a manufacturer announces a price increase due to an external factor like the increasing price of aluminum. So I started my training and mentoring career in aerospace, and we used a lot of should cost analysis in aerospace with all kinds of parts. I worked with tier 2 and tier 3 manufacturers to Airbus and Boeing. So we had to be very conscientious of the parts that we were purchasing and the costs that were then pushed to the airframe manufacturer. It is for parts. We don't do a should cost analysis for a service, and I'll tell you about that in the fourth kind of analysis. Now, the goal of a should cost analysis is to develop a comparison of what the supplier is quoting as a price increase and what the buyer's own analysis shows the price increase should be. Now, the second kind of financial analysis is a total cost of ownership. This is also for goods and products. Now, a TCO analysis establishes the cradle to grave purchase costs of an asset over the life of that asset. Now, a total cost of ownership analysis is especially helpful when making capital purchases such as large machinery. A thorough analysis uncovers all of the lifetime costs associated with owning certain kinds of assets. For this reason, a TCO is sometimes called a life cycle cost analysis. Now, this can be done either by the buying company or by the manufacturing company. And typically, it's a team function, meaning the functional team, which would include finance, engineering, procurement on the procurement side, or sales if you're on the sales side, and operations conducts this TCO analysis. Now, the contracting professionals, sales, and procurement use this analysis to help negotiate pricing, terms, and conditions to ensure that the value of that asset is the total cost for the entire life cycle of that asset. Now, the third type of financial analysis is total landed costs. Now, total landed costs is a subset of a total cost of ownership or is bolted on to a should cost analysis. A landed cost is the total price of a product once it arrives at the buying organization's manufacturing door. And that's a door-to-door cost, leaving the door of the sub-manufacturer, subcontractor, and arriving at the buying organization manufacturer. So that's duties, tariffs, customs. It's all the freight from door to door and any interim storage that may be included. A TLC is the sum of all costs associated with making and delivering the products to the point where they produce revenue. So a really, really expansive TLC would also include all of the costs it would take for that product to leave a manufacturer's facility and then start generating income when it's sold to, let's say, the airframe manufacturer. And depending on the industry, the factors to calculate a total landed cost can vary. So it really is dependent on your industry. But I will let you know that sometimes if you do a should cost analysis, you may determine that one part of the globe can produce a widget at a seemingly lower price, but when you bolt on to it the total landed cost for that object, another part of the globe may actually balance out to be less expensive, meaning a widget can cost $5 from Southeast Asia, but the travel costs, tariffs, customs duties, all those fees, and maybe some warehousing will exceed purchasing this from, let's say, North America, Canada, or Mexico, where those total landed costs are sharply decreased, leaving one geography when you include should cost and total landed cost as being less expensive than another geography. Now, the fourth and final type of financial analysis is an activity-based cost analysis, and this is for services. Companies that are very big use this kind of analysis or to determine whether a service should be outsourced or not. Activity-based costing is similar to a total cost of ownership, but is for services rather than an asset. Like a TCO, activity-based costs seeks to capture cradle to grave costs of a service. So instead of calculating the cost of an asset, you calculate the total cost for a service, which means you incorporate the buyer's costs for any existing direct costs to oversee the outsourcing, but you also have to incorporate all of the indirect costs. And this is where it gets really challenging. Companies really struggle to determine how many square feet do we still need for our internal team of oversight? How much of financial and accounting time do we still need? Do we need more now because this is outsourced and this is going through contract management? And those kinds of determinations help make it the business case to outsource an activity or keep the activity in-house, or what portion of the activity should be maintained in-house. Ideally, companies really do this analysis. They would not stumble in outsourcing on hidden costs that negatively impact the other divisions of the company. And by that, what I mean is when we have all the direct costs for employees, that's one arm of a finance department for payroll and HR. When we're now getting invoices that are potentially in the hundreds of thousands a month for the activity, then that requires a different kind of financial analysis and contract or vendor management. And if we don't understand that, then while we save over here in HR employee costs, we don't adequately fund the financial and contract management or supplier, or vendor management arm. And therefore, that's when we get all these stumbles, and it creates that sense that the buying company had all of these hidden costs with transferring certain services outside of its own organization. Now, gathering cradle to grave costs for a service is much, much, much harder than a TCO, just FYI. So I have not seen it very frequently, just in a couple of instances where companies used the vested outsourcing model that I write about in the vested outsourcing manual. Well, since you watched to the end, you might be interested to know that my book, The Contract Professional's Playbook, has several chapters to help you prepare for and effectively negotiate price. So here's how you can get your copy today. And here's a link to a webinar on financial analysis if you'd like a slightly deeper dive into this topic. It's the Best of Jeanette part of the series. It's a little bit of a deeper dive with slides that demonstrate should cost, total landed costs, TCO, and activity-based costing. Now remember to share this video with your team members. It's free.